Hi everyone, nice to meet you. My name is Sarah Keys and I'm a Chartered Professional Accountant. I'm here today on behalf of CPA Canada's Financial Literacy Program, and I'm going to be talking to you about maximizing your business. We'll start off by asking some of the common questions that business owners ask. This information is highly important to ensure you have a profitable business. Some of these questions are, sales are great, why don't we have any cash? Do we have enough cash to pay expenses? How much cash do we need for expansion? How can I free up some cash from the business? How do I get customers to pay sooner? And are we managing cash efficiently? So a business must have cash available for its operating activities. And a typical business cycle might be purchasing inventory, selling product to your customers, paying your bills, and receiving payment from your customers. And there may be a time lag in between these different stages of a typical business cycle. Purchasing inventory and paying bills require the business to spend cash prior to receiving payments from customers. Since cash must be used before it's received, it's important to understand how much cash is needed in day-to-day operations of the business. Working capital is a measure of the liquid assets available to be used in the operation of the business, and it's calculated as the difference between current assets and current liabilities, both of which can be found on the balance sheet. As a reminder, current assets consist of cash, inventory, and accounts receivable, whereas current liabilities consist of any accounts payable. The difference between current assets and current liabilities is known as the working capital. So this slide presents an example of the calculation of working capital. So our sample business has $10,000 of cash, $20,000 of inventory, and $75,000 of accounts receivable. So current assets total $105,000. Now, the business has purchased $20,000 of inventory, and that's a use of cash. And it's now waiting for $75,000 in payments for customers. On the other hand, our business had $15,000 of accounts payable. So when we calculate our working capital, it's $90,000, which is the difference between $105,000 of current assets and $15,000 of current liabilities. The previous slide presented an example for a static business, that is, a business that isn't growing. But one of the problems many businesses face as they go through a growth spurt is that they need additional working capital to fund that growth. And if they don't have access to additional funds for working capital, they can find themselves in a cash crunch. You may want to emphasize that the business will not be able to capitalize on the opportunity for growth if they don't have sufficient working capital available. When growth occurs, it's important to have identified additional sources of working capital. It's particularly important to have identified those sources prior to the growth occurring, when your business is already in a cash crisis. So sources of additional working capital can include funds already in the business, such as cash on hand. But in our example, the business only had $10,000 of cash on hand and an additional $16,000 required to facilitate that 20% growth in sales. So we'll have to look to other sources. Some of the other sources of working capital can include additional investment by the existing owners, new investments by others, and borrowing of additional money by the business. Now that we understand how to calculate working capital, let's take a look at measures of operating efficiency. Operating efficiency is measured by how quickly sales are converted to cash by the business. A business that's able to quickly convert its sales to cash is operationally efficient, and as a result will use less working capital than a business that is slower at converting sales to cash. So we're going to look at 5 key operational efficiency ratios today. The first is days in inventory, the second is collection period, the third is payment period, the fourth is cash conversion cycle, and the last one is inventory turnover, and we'll walk through examples of each of these. As a reminder, improving operational efficiency can reduce the amount of working capital needed. The more operationally efficient your business is, the less working capital you'll require. Days in inventory is the first operational efficiency ratio we'll be looking at. And really, it's the measure of how long inventory stays in the business before it's sold. So although inventory is classified as an asset on the balance sheet, there are also costs associated with acquiring, carrying, and storing this inventory until it's sold. Days in inventory measures how long the inventory stays in the company before it is sold. The faster inventory is sold, the less working capital is required. In other words, the less days in inventory, the less working capital needed. So the formula for days in inventory is ending inventory, which can be found on the balance sheet, divided by the cost of goods sold per day. Now, the cost of goods sold will come from the profit and loss statement. To convert it to a per day number, you'll simply divide by 30 if it's found on a monthly profit and loss statement, or by 360 if found on an annual profit and loss statement. So using our example from before, our business had $20,000 of inventory and $18,000 of cost of goods sold per month, indicating that the business has 33 days of inventory on hand. The next operational efficiency ratio we'll look at is the collection period. The collection period measures how quickly payment is received from customers. So in addition to purchasing the inventory, the other use of cash is that you need to purchase your inventory today and allow your customers to pay at a later date. So the amount of money that the business is out of pocket during this time lag is reflected in its accounts receivable. The collection period is a measure of how quickly or slowly customers are paying back to the business. The formula for collection period is ending accounts receivable, which can be found on the balance sheet, divided by revenue per day. Revenue can be found on the profit and loss statement, and to convert into a revenue per day figure, you simply divide by 30 if revenue has come from a monthly profit and loss statement, and 360 if it's come from an annual statement. In our example, the business has $75,000 of accounts receivable and monthly revenue of $50,000. Therefore, the collection period is 45 days. This means it takes 45 days for the business to convert a customer's sale into cash. Remember, the shorter the collection period, the less working capital needed, and vice versa. The next measure of operational efficiency is the payment period, and you can think of this as the inverse to the collection period. This is the amount of money a business owes its suppliers and vendors, and it's reflected in accounts payable on the balance sheet. The longer a business takes to pay its suppliers and vendors, the longer it is able to hold on to cash. Taking a longer time to pay suppliers and vendors is actually a source of cash for the business and can help to offset the cash needed to pay for inventory. The formula for the payment period is accounts payable, found on the balance sheet, divided by cost of goods sold per day. As a reminder, cost of goods sold can be found on the profit and loss statement. To convert it to a per day figure, you'll divide by 30 if found on a monthly profit and loss, and divide by 360 if found on an annual profit and loss statement. In our example, the business has $15,000 of accounts payable and $18,000 cost of goods sold, so the payment period is 25 days. This means it takes the business 25 days to pay its suppliers and vendors after making a purchase. Next, we'll look at the cash collection cycle, which is really a accumulation of the first three ratios that we discussed. The cash collection cycle is a measure of the length of time that the cash is tied up in the business. It's calculated by adding the uses of cash, days in inventory, and the collection period, and subtracting the sources of cash, the payment period. So in our example, we had 33 days in inventory, a 45-day collection period, and a 25-day payment period. So as a result, our cash conversion cycle is 53 days. This means it takes our sample business 53 days to convert its products into cash. Note that the cash conversion cycle is also known as the cash collection cycle, and these terms are used interchangeably. The last measure of operational efficiency that we'll be looking at today is the inventory turnover ratio. And this is a measure of how many times per year the company sells all of its inventory. This is also known as turning over its inventory. Note that this is an annual measure, so it's calculated by dividing the total annual cost of goods sold by the inventory. So in this case, we do not have to divide by 30 for a monthly profit and loss or 360 for an annual profit and loss because we are looking at an annual figure. So in our example, cost of goods sold was $18,000 and inventory was $20,000. So the inventory turnover was 0.9 times. Well, what does this mean for my business? Well, inventory turnover and how well you're performing is all relative to the type of business that you're running. A high volume business, such as a food retailer or a gas station, might turn over its inventory many times during the year, while a low volume business, such as a furniture store, might have a very low inventory turnover. It is important to compare inventory turnover for your business to what's typical for your industry and your key competitors to understand how well you're managing your cash. This is where you might want to leverage the examples from the sectors in the classroom that you're teaching. You can explain to them by using actual industry benchmarks so they can evaluate where their company falls on their inventory turnover ratio. Now that we've defined the 5 different types of efficiency ratios, let's examine how to increase efficiency and reduce the amount of working capital needed by the business. If a business wishes to manage cash more efficiently and reduce the amount of cash needed to operate the business, it can look at improving 3 things: inventory management, decreasing the collection period, or increasing the payment period. This slide presents strategies for reducing days in inventory, our first operational efficiency measure. Firstly, customer demand and projected sales for each product can be evaluated in an effort to align inventory with projected sales. Slow-selling items can be eliminated, the amount of safety stock can be reduced. So this will remove the amount of money and time you have tied up in your inventory. Order cycles and order quantities can be optimized to either take advantage of beneficial pricing or to reduce the amount of inventory that's stocked. Expensive or slow-selling items can be direct shipped from the manufacturer to the customer, thereby removing the intermediary. And lastly, obsolete and slow-selling inventory can be eliminated entirely. One of the best strategies to reduce the collection period is to make sure that invoices are sent promptly and that they are correct when they are sent. A simple way to do this is to invoice as sales are made or as work is completed multiple times throughout the month, rather than waiting to the very end of the month. This allows customers to pay more quickly as they received your invoice sooner. You also want to enforce the payment terms, including the due dates and payment deadlines, in order to be eligible for discounts. Offering a discount to your customers to encourage quicker payment may be desirable depending on the type of business that you're operating. Typical discounts offered on invoices are minor, and a typical term that's used is 2% in 30 days. Another technique to reduce your collection period is resolving disputes quickly. Remember, the longer it takes to resolve a dispute, the longer it will take to receive payment from the customer. You may want to take this opportunity to ask your audience some of their techniques and tools in order to receive payment from customers more quickly. What are some of the ways to improve your payment efficiencies? A business should manage when bills are paid, paying bills when they're due, but not before, and maximizing discounts where they're available. Some simple techniques are negotiating payment terms with vendors and suppliers, and attempting to align those with your collection terms. Further, you can structure your payment so that you can obtain discounts and maximize those discounts when they're available from suppliers. So, now that we've offered you a few strategies and techniques for reducing your cash conversion cycle and reducing the amount of working capital required by your business, let's walk through an example. So this slide contains an example of a company that made some operational changes in an effort to improve its operational efficiency. Inventory has been reduced by 10%. As a result of this 10% reduction in inventory, days in inventory drops from 33 days down to 30 days. The business improves its collection process by moving its customers to an electronic payment process and modified its processes to process payments more efficiently. Electronic payments save 4 days in the collection process, while prompt invoicing saves an additional 5 days. As a result, the collection period drops from 45 days to 36 days. Lastly, our business began paying bills when they were due, but not before. This results in a 3-day increase in the payment period. Overall, the cash conversion cycle drops from 53 days to 38 days. Using that same example, we'll now see the impact on the working capital calculation. So in our prior example, we had cash of $10,000, inventory of $20,000, accounts receivable of $75,000, for a total current assets of $105,000. Current liabilities consisted of $15,000 of accounts payable. So overall, our business needed $90,000 of working capital. After the efficiency changes, inventory has been reduced to $18,000, accounts receivable reduced to $60,000, cash still remains at $10,000, so current assets are now $88,000. Because the payment period has been extended by 3 days, our current liabilities have increased to $16,800. So working capital needed by the business is now $71,200, a reduction of $18,800 from our original example. Efficiency ratios are valuable tools used by the business to monitor their cash usage and cash needs. Efficiency ratios should be calculated and monitored regularly. They should be compared to your industry, and trends should be analyzed. Most importantly, adverse changes should be investigated. Improved operational efficiency can free up working capital, as we saw in the previous examples. Simple strategies such as carrying less inventory and getting paid sooner can provide significant working capital benefits for your business. As outlined on the slide, there are additional resources available to you, including a glossary of terms which will have helpful definitions as you implement some of these working capital ratios, and an implementation checklist. At this time, I'll open up the floor to any questions or comments that you may have, and thank you very much for your time in listening to this presentation today. If someone is asking you questions about anything personal to their own business, advise them that they should consult their own financial planner. Thanks again to everyone for your time, attention, and participation today. I hope you found this content valuable. And looking forward, I wish you the best of success in managing your working capital needs for your business.